Right, good afternoon, grade 12s. This lesson today is looking at the company profits and what they do with those profits, and then focusing particularly on the payout rate. Now, this has become a very typical question in examinations where you're asked to calculate and then secondly, comment on the payout rate. So let's go back and just have a look. We know that a company makes profits. That's why they're in business, to make profits. The first thing that has to happen is out of those profits, taxes have to be paid. And at the moment, we're sitting at a rate of 28% of the profits gets paid as company tax. So that is compulsory. It has to be paid before anything. Once the taxes have been paid, whatever is left over then belongs to the shareholders of the company. Now, that profit that's left over, well, they have to make a decision what they're going to do with it. And first of all, they will look at paying out dividends to the shareholders. Remember, the shareholders are the owners of the company. They've invested in the company in order to earn a return. So they are going to be looking for a return which is paid out in the form of dividends. But secondly, the directors must also decide whether they want to retain. Now, retain means to keep back. So, in other words, this profit that's been made after we've paid the taxes, some of it will be paid as dividends and some will be retained. Or all of it could be paid as dividends, all of it could be retained, or some combination. The retained income is then invested back into the company as part of the capital. Still belongs to the shareholders, so it's part of their shareholders' equity, and it just means that their equity, the amount of money that they've got invested, has grown, and with that extra capital they can hopefully expand the business in the future and therefore make more profits. So now let's look at an example. If we've got a company that makes 5 million rand profit, their income tax is 1.4 million. That leaves them with a profit after tax of 3.6 million. So that is at this point over here. So they've paid their taxes and they've now got 3.6 million. And they must decide what to do with it. All of that 3.6 million has to be allocated out. So in this example, they decide to pay out dividends of 1,620,000. Now that, remember, comes out of this profit after tax. That minus that, it will leave you with 1,980,000. That is the amount that they're going to retain. So very importantly, these two here must equal the 3.6 million because you have to allocate it all. Now, you will then be asked, using these figures, to first of all calculate the earnings per share and the dividends per share. Now, the earnings is what the shareholders earn. Very different from what they take out. They earn the profit after tax. It all belongs to them. They might not be taking it all out of the business now as dividends. They're going to retain some, but it doesn't detract from the fact it's still their earnings. So the first calculation you'll have to do is a earnings per share. That is your profit after tax, and we divide that out amongst all the shares, the number of shares we've got. So we had a profit of 3.6 million. We had 1.8 million shares, and that equals to 200 cents. Now we want our answer in cents, so that's why I've multiplied by 100 over 1. So every share is earning 2 rand or 200 cents. But then, of that earnings, they paid out 1,620,000. And so that leads you to the next one, which is your dividends per share. Now these dividends, at 1.6 million, is your interim that have been paid out during the year, plus the final, and again divided by the number of shares. And that gives you an answer of 90 cents. So what it's meaning is that out of the 200 cents that we earned, 90 cents has been paid out to the shareholders. The difference, the other 110 cents, has been retained in the company for future growth. Now, while those two calculations, the earnings and dividends, are important to be able to calculate and to comment on, it's not enough on its own. You need to take it one step further, and that is to work out what we call the payout rate. How much of the earnings are you paying out? So, if we're paying out 90 cents out of the 200 cents that we earned, I'm going to times by 100 this time because I want a percentage. Remember, whenever we've done ratios, we've always converted back to a percentage, because then you can compare from year to year or from one business to another business. So that will mean that 45% of what they've earned has been paid out. The other will be retained. Now, whether that's good or bad will first of all have to be compared to last year. So let's say, for example, that last year they paid out 60%. All right, which means that last year they would have only retained 40%. All right, because they paid out more last year, they would have retained less than what they have done in this year. Now, which situation you would be happier on depends on the type of shareholder you are. If you're a shareholder that's looking for future growth, and this is generally a younger person, they would be looking for the greatest retained income. The greater the retained income, the more the prospect of future profits. Whereas if you're an older shareholder and you need to live on your dividends, you're going to really want the dividends to be as much as possible. So in the first situation, you'd probably be happier this year because the company has decided to retain more than they did last year. Whereas if you are a person that leads the dividends, you would have been happier last year. Now, I strongly suggest that you decide before you go into an exam which of these shareholders are you going to be, and then argue from that point of view, because there's no right or wrong. They're both correct. But don't go wasting your time in the exam arguing from both point of views. Right, learners, so you need to be able to do these calculations and then very, very importantly, be able to comment meaningfully based on your figures.